At the end of 2022, Ireland's public debt stood at an estimated €226 billion. That equates to just over €44,000 worth of debt for every man, woman and child on the island of Ireland, among the highest of per capita debt burdens in the world. However, all is not as it seems. There is much more to Ireland's public debt than meets the eye, with both pros and cons to be considered. Regardless, it's undeniable that the uncertainties of the future present significant risks to the sustainability of Ireland's public finances. This video seeks to unpack the Irish debt situation so that the strengths, weaknesses, opportunities and threats of Ireland's public debt can be better understood. The Department of Finance's annual report on public debt in Ireland 2022, which was released in February 2023, will be the main source of information for this video. The link to this paper will be in the video description. All sections of this video will be timestamped for your convenience. Let's begin with some of the fundamentals. What do we mean by the term Ireland's public debt? Put simply, Ireland's public debt refers to the total amount of money that the Irish government has borrowed. The National Treasury Management Agency, or NTMA, is the agency that's responsible for borrowing money on behalf of the government. That begs the question, how does the NTMA borrow money? The primary method is through the issuance of Irish government bonds. What is an Irish government bond? An Irish government bond can be thought of as an IOU that is issued by the Irish government, or rather the NTMA on behalf of the Irish government whenever they need to borrow money. These IOUs are sold to investors all around the world. Two things happen when Irish government bonds are sold to investors. Number one, the investors purchase the bonds with cash, meaning the government receives the money that it needs. And number two, the government promises to repay the investors in full at the end of a specified period, hence IOU. Why would an investor agree to this arrangement? Between the date of purchase and the date of repayment, the investor will collect interest payments from the Irish government. How much interest they receive depends on how many bonds they bought and the interest rate attached to those bonds. If this sounds similar to a loan, that's because it is. Irish government bonds can be described as IOUs, or loans made to the Irish government by investors. But the most important thing to understand is that government bonds are a form of debt. According to the NTMA, Ireland's gross national debt, which is slightly different to its public debt, can be broken up into 6 categories: government bonds, EU loans, state savings products, short-term paper, other medium and long-term debt, and borrowings from ministerial funds. As you can see, at the end of February 2023, government bonds accounted for over 62% of Ireland's gross national debt. But why does the government need to borrow money in the first place? The main reason is to ensure that there's money there when it's needed. For example, in the case of the pandemic, had the government not been able to borrow money to support incomes, there could very well have been an exodus of both workers and companies from the country. From a policy perspective, problems such as an aging Irish population, the Irish housing crisis, and the shift to carbon neutrality are expensive problems to solve. Positive change comes at a cost. If the Irish government relied solely on tax revenues to fund its policies, then its policies would take longer to implement. Certain policies simply aren't feasible without borrowing money. As you might expect, how much the government borrows is largely dependent on what is needed at any given point in time. Ireland's public debt, as it stands today, is a direct reflection of Ireland's past needs. The Department of Finance paper notes 5 separate waves of debt which have occurred since the year 2000. Wave 1 was between 2000 and 2007 during the Celtic Tiger. During this time, debt levels in Ireland were very low. Ireland's debt to income ratio, which measures Ireland's debt as a percentage of Ireland's income, was below 30% in both 06 and 07. Then came wave 2 between 2008 and 2012, i.e. the global financial crisis and the sovereign debt crisis. The global financial crisis had serious consequences for Ireland's public debt. At the time, there was a large mismatch between public revenues and expenditure. Tax revenues decreased as a result of lower capital taxes, lower income taxes, and lower VAT receipts. The state support for the failing domestic banking sector, among other factors, caused large deficits. As a result, Ireland's debt increased to €160 billion between 2008 and 2012, and this debt wasn't cheap. Investors were demanding high interest rates in order to compensate for the high risk associated with lending to Ireland at that time. Ireland's debt to income ratio went from under 30% in 07 to 160% 165% by 2012. The public debt accumulated during this period is the main reason why our per capita debt burden today is among the highest in the world. Wave 3 came between 2013 and 2019, where a combination of favourable lending terms, quantitative easing and export growth allowed Ireland to reduce its debt to income ratio to below 100% by 2019. Wave 4 was between 2020 and 2021, where the emergence of the global pandemic once again necessitated the need for borrowing. Public debt had increased by €33 billion by the end of 2021. When combined with a reduction in economic activity due to restrictions, Ireland's debt to income ratio increased by 12 percentage points in 2020, but actually decreased by 8 percentage points in 2021, primarily due to strong corporate tax receipts, which we'll talk about later. Finally, Wave 5 is the period between 2022 and 2025. The projected debt to income ratio for 2025 is 73%, which is predicated on strong economic growth and surpluses. But as we'll talk about later in the video, the future is filled with uncertainties, and those uncertainties have the potential to derail any efforts made to improve Ireland's public finances. But before we get there, we first need to assess Ireland's public debt under two headings: interest rates and maturity profile. One of the key takeaways from this video should be the following: not all debt is born equal. The headline of €44,000 worth of debt for every man, woman and child is somewhat of an oversimplification, because it could be taken to mean that every euro of debt is the same as the last. It's only when we analyse Ireland's public debt on the basis of interest rates and maturity profile that we get a more accurate picture. Let's start with interest rates. What do interest rates have to do with Ireland's public debt, and why do they matter? As we explained in the fundamentals section, the interest rate attached to an Irish government bond determines the interest payment that the bond investor receives. Therefore, the interest rate offered on Irish government bonds determines how expensive it is for the government to service its debt. Clearly, it's in the best interests of Irish public finances for Irish government bonds to be sold at low interest rates. But this isn't always possible. Interest rates on Irish government bonds are influenced by the key interest rates for the euro area, which are set by the European Central Bank. As you're no doubt aware, the ECB has been continuously increasing interest rates to combat inflation. When interest rates go up, bond investors expect to receive higher interest payments, and as a result, new government bonds which are sold at higher interest rates. This in turn makes it more expensive for the government to borrow money. This also explains why there's an inverse relationship between interest rates and bond prices. As interest rates go up, the value of existing bonds go down. This is logical because bond investors know that they could get a higher interest rate elsewhere with newly issued bonds. This reduces the demand for existing bonds, which in turn causes their value to fall. Hence why bonds have performed so poorly since ECB interest rates started rising. Conversely, as interest rates go down, the value of existing bonds go up. This is because bond investors know that new bonds will offer a lower interest rate. This increases the demand for existing bonds, which in turn causes their value to increase. The key question here is the following: what are the interest rates attached to Ireland's public debt? Not all debt is born equal. Some of Ireland's debt is bound to have been issued at high rates, some at low rates, ideally more low than high. 3/4 of Ireland's gross national debt is currently at rates below 2%. €105 billion has been issued between 0% and 1%, €66 billion has been issued between 1% and 2%, €24 billion has been issued between 2% and 3%, €22 billion has been issued between 3% and 4%, and €15 billion has been issued between 5% and 6%. But most importantly, the vast majority of Ireland's low interest debt has been issued at fixed rates, i.e. the rate will not change in response to changes in the key ECB interest rates. If the majority of this debt was issued at variable rates, then there would be cause for concern. As a whole, the effective interest rate of Ireland's public debt, which is the annual interest bill expressed as a percentage of the total public debt, is 1.5%, down from a peak of 5% in 2008. A big part of the reason why Ireland has been able to secure the majority of its debt at interest rates below 2% is because of quantitative easing. Quantitative easing is where monetary policymakers like the European Central Bank commit to purchasing a range of financial assets, including government government bonds. Quantitative easing was a key characteristic of European monetary policy between 2013 and 2021, at a time when interest rates were at historic lows. This allowed the NTMA to issue Irish government bonds at low interest rates. Ultimately, interest rates on Irish government bonds determine the cost of borrowing, and the cost of borrowing is crucial to the sustainability of public finances. That brings us on to the maturity profile of Ireland's public debt. To understand what we mean by maturity profile, we first need to understand maturity. Maturity, as it relates to debt, and more specifically government bonds, refers to the point in time at which the IOU will be paid by the government. So if the Irish government borrows €1 billion today through the issuance of 10-year government bonds, then the government will repay the €1 billion in 2033 when the bonds mature. So when we talk about the maturity profile of Ireland's public debt, we're talking about a breakdown of Ireland's debt by value and time to maturity, aka time to repayment. Different bonds have different maturity periods, and those bonds can be issued at different points in time. Therefore, over time, different lots of bonds will start to mature. The main implication of bond maturity is the fact that the government will need to have cash on hand to repay the investors. If the Irish government borrows €1 billion through the issuance of 10-year government bonds, and 10 years later those bonds mature, how do you suppose the government comes up with the €1 billion required to repay the investors? Because it's a fair assumption that the government has spent the €1 billion that it borrowed. The answer, more often than not, is that the government will issue €1 billion worth of new bonds, and that money will be used to repay the investors in the old bonds. In effect, the Irish government is refinancing their old bonds at current interest rates. Refinancing can be both a blessing and a curse, but in the current interest rate environment, it's far more likely to be a curse than a blessing. Why? Because as we mentioned earlier, the ECB has been continuously increasing interest rates. Refinancing at current rates would result in the Irish government paying higher interest payments than it was before, which isn't beneficial to public finances. So the key question is how much of Ireland's public debt is set to mature in the near future, because that will give us an idea of how much refinancing will be necessary at current rates. Ideally, we want to see a long maturity profile in times when rates are high and or rising, and a short maturity profile in times when rates are low and or falling. The weighted median maturity of Ireland's medium and long-term debt portfolio is 8 years. This means that 50% of Ireland's medium and long-term debt is due to mature within the next 8 years. According to ESDM metrics, Ireland's 5-year maturity profile is 9 percentage points lower than the EU average. In the current interest rate environment, that puts Ireland in a strong position relative to its EU counterparts. We can delve deeper into the numbers. €9 billion worth of debt is set to mature in 2023, which somewhat aligns with the NTMA's intentions to raise between €7 and €11 billion in the bond markets this year, thereby highlighting the practice of refinancing. At a high level, €56 billion is set to mature between 2023 and 2027, €96 billion is set to mature between 2028 and 2035, and €44 billion is set to mature beyond 2035. However, we can see that 19.5 and 21.4 billion euro worth of medium and long-term debt is set to mature in 2030 and 2031 respectively. According to the report, this is due to the large volume of 10-year government debt issued following the government's response to the pandemic, which was aided by the ECB's Pandemic Emergency Purchase Programme, i.e. quantitative easing, as well as almost 7 billion euro of EFSF loans maturing. Inevitably, the government will need to refinance a portion of this debt, and if interest rates are high in 2030 and 2031, that could spell trouble for Ireland's public finances. The main takeaway here is that the maturity profile of Ireland's public debt is set up in such a way that public finances are protected from significant changes in interest rates in the short term. However, should high rates persist over the medium term, then higher borrowing costs are all but inevitable, be it through refinancing or the accumulation of new debt. So if the majority of our public debt is locked in at low interest rates with relatively long maturity profiles, is there any real cause for concern? The concern isn't necessarily for Ireland's existing debt, it's for the circumstances that could necessitate the issuance of new debt in the future, which, as we've discussed, would likely come at higher rates. One such circumstance is a decline in corporate tax revenue. Ireland has a significant over-reliance on corporate tax receipts, and not corporate tax receipts as a whole, but corporate tax receipts from a very small number of companies. 1 in every €4 of all tax collected in Ireland is sourced from corporation tax, and of that €1, over 50 cents came from just 10 large companies in 2021. To make matters more complicated, it's generally accepted that Ireland's corporate tax receipts in 2021 and 2022, while impressive, aren't sustainable. Corporate tax receipts reached €22.6 billion in 2022, an increase of 229% relative to 2015 and double the figure from 2020. The Department of Finance has estimated that around €10.5 billion of these corporate tax receipts could be windfall in nature. In other words, more of a once-off than anything else. What do you suppose would happen if those windfall corporate tax receipts disappeared? Earlier we mentioned that the projected debt-to-income ratio for 2025 is 73%. If we account for a full elimination of the windfall corporate tax receipts, that projection worsens to 83%, 10 percentage points higher. Why is this the case? With lower corporate tax receipts, large deficits could start to form. Remember the aging Irish population, the Irish housing crisis, and the shift to carbon neutrality? Solving those problems, among others, with lower tax revenues would necessitate borrowing at high rates. But the forecasts get worse. If the elimination of windfall corporate tax receipts were coupled with a reduction in economic output, which would very likely be the case, then the increase in the debt-to-income ratio for 2025 is even higher. 90% where output is 2 percentage points lower than the baseline, and 100% where output is 5 percentage points lower than the baseline. A shock to corporate tax receipts has a much greater effect on our debt-to-income ratio than a shock to interest rates, primarily because our public debt is locked in at low interest rates with relatively long maturity profiles. It just goes to show how important it is for Ireland to reduce its reliance on corporate tax receipts if our public finances are to be sustainable. This all comes back to the Commission on Taxation and Welfare's report in 2022 entitled Foundations of the Future, where they noted that Ireland faces major fiscal sustainability challenges. Over time, the overall level of taxation as a share of national income will have to increase, and we can't rely on corporate tax receipts for that increase. In conclusion, Ireland's public debt isn't cause for concern in the short term. The NTMA has been able to secure low-cost, fixed-rate debt with long maturity profiles, which has insulated the public finances from the recent change in interest rates. In 2022, Ireland spent just 3% of its revenue on interest payments, which is in line with the EU average. In addition, the government holds over €100 billion in financial assets made up of currency and deposits, equities, loans, and other assets. However, Ireland has a significant over-reliance on corporate tax receipts, which could necessitate a refinancing or accumulation of new debt at higher rates. As we look to the medium and long term, the Irish debt situation is more uncertain in the face of a high interest rate environment. The uncertainties of the future demand that we continue to build up our fiscal buffers like the National Reserve Fund, which has already seen a top-up of €4 billion this year on the back of 2022's windfall corporate tax receipts. Ultimately, we can't predict the future. We can estimate the impact of known risks, but unknown risks present perhaps the greatest threat to our public finances, and we were reminded of this during the global pandemic. Let me know what your thoughts are on the Irish debt situation in the comment section. If you enjoyed this video, consider sharing it with your family and friends. The more people who are engaged in this conversation, the better, because this topic affects us all. You can show your support by leaving a like on the video and subscribing to the channel. Before you go, you might be interested in this next video, which answers the question, should you buy a house in Ireland now or wait until 2024? Thanks very much for watching, and I'll see you soon.